Good afternoon, everyone, and welcome to our webinar on data requirements for credit risk modeling. This is the first part of a three-part webinar we will be hosting. The first part will talk more about the first steps of setting up a credit risk scorecard and the modeling associated with it. The second part, which will be held in October, and you can find it on our Eventbrite page, mm, will talk more about the actual modeling, model building, and scorecard development and the best practices around it. And then the final part of this three-part webinar series will be in November, and it will talk about best practices around maintenance and validation of the scorecard. So on to data requirement for credit risk modeling. So So there are many things to consider while developing a credit risk scorecard. There is the data, which we'll talk about a little bit more today. There are models to consider what kind of models you will build, um, uh, whether your system will be able to support those models, whether they will pass regulatory requirements if you are in a bank. Then from model, we go to scorecard. The model gives you kind of probabilities of someone charging off. And then from there to get to kind of a scorecard, which gives you a scale, and each band in the scale has a certain loan loss ratio, and based on that you make your credit decisions, pricing decisions. And so the questions there would be, okay, what is going to be the scale of the scorecard? What makes sense? Uh, what kind of range do you want, or at how many the rate at which your scores kind of uh, double in terms of odds of going well of loss, and so on. So these are some of the things you have to think about in designing the scorecard. And then there is the scoring platform, where you are essentially a implementing the scorecard. This is where all the action happens. The rest is all development. So your scoring platform should be able to support everything you do in the development phase, and it should be able to meet your credit officer's requirements of getting the credit score to them at the right time for them to make decisions. So there is data availability, technology compatibility, a kind of decisions and knowledge that needs, and this needs to be figured out upfront. Another factor which you need to think about in developing is what are the segments you want to build on, and segmentation could be driven by business requirements, it could be driven purely by data science, it could be driven by uh, data availability, and we'll talk a little bit about that today. And then there is model performance tracking, which is very important. You need to know how your model is doing, how the scorecard is performing. All of this is very important, and we'll have a separate series on that. But uh, the reason I'm putting this all upfront is these are not independent decisions. uh, what kind of scoring platform you choose or have will determine the kind of data you can use. And your data will availability might determine your segmentation decisions. Your business practices might determine your scorecard requirement, and that might have some implications on the models you build. um, um, In the model tracking and performance, if you are in a bank as opposed to being an independent equipment finance company, the banks might have certain regulatory requirements, and based on that, your modeling decisions have to be made upfront. Your data, what data you use, that has to be made upfront. So you might have a higher threshold to meet in terms of uh, doing certain validation tests, and so and have, producing certain kind of reports, and based on that, your some modeling techniques might not work for you. So all of these things need to be decided upfront, and while you won't be able to make final decision on all of these at the start of the project, it is a good idea to spend good time thinking through all of this, and then developing your credit risk uh, scorecard. Okay. If you have any questions, you feel free to use the chat board to share them with me. So, what I was talking about in the earlier slide, kind of are elaborating on that here, and asking some specific questions, some business decisions which need to be made upfront. What is the best observation period to measure default? So, you know, uh, that's the interesting thing. In when you first talk about it, a charge off is a charge off. But then when you are trying to implement it in a model, it becomes okay. How much do I look at performance of a loan to decide if there is charge off? Like, and most equipment finance loans are term driven, so there is clearly the term, the average term of the product matters, and therefore this definition of default might vary by product. For example, if most of your equipment finance loans are for 24 months, or you feel, or you have seen that if they have to go bad, they go by a bad by 24 months in general, most of the time. Based on that, you could say, okay, I'll take a 24-month observation window. But you might have a working capital product where maybe a 12-month window might be more relevant because those are more short-term loans. So these kind of decisions have to be made. These will have implications for data, like the longer observation window you take, the more performance data you will have to pull from and it might have some costs associated with it as well, especially if you are doing reject inferencing, and I'll talk about that a little bit later down. And then how is default defined? Uh, and that can vary by product and industry, but some clarity is needed as to, okay, what is default? And um, in certain uh, mm, products, it might be okay, the customer has not paid for 90 days, then I would take that as a default. Or the customer has missed 3 payments, okay, that's a default. uh, some Basically, some kind of clarity is needed so that we can mark something as default. Mhm. Then another decision which needs to be made, and this I touched upon earlier, is what are the data and computational constraints in the implementations or scoring environment. There are certain implementation environments where certain mathematical calculations cannot be done. Or in the scoring, the development environment, the data provider, the bureau gave you data from their archives. In the scoring environment, they will pull it you will have to pull it from their API feed. And while the data feed might be similar, they are not exact. And some data which is available in the archives might not be available in the API, or vice versa. So that all that needs to be figured out. So, and then what is the appropriate scale of the scorecard? For example, if you are using, you know, FICO to make certain PG decisions, then, and if you are going to replace that with a custom scorecard for some PG loans, then maybe it will be easier for your credit officers if you kind of uh, replace FICO with a scorecard which has a similar range, so that it is easier for them to interpret. Or there could be, you could be using some other score, SBSS or anything, and each has its own scale which your organization might be using for reporting, for its or for its credit decisions. And there might be some desire to have a similar scale. Or even if you want to have something different, you still need to figure out what that scale is. You don't necessarily need to have that answer at the beginning of the project. This is something which can be done after the models are built, but it is a good idea to start thinking about it, so that this doesn't become a bottleneck. Mm. And again, there might be some um, in scoring environments where all kinds of scales might not be possible. Again, so it's good to keep touch and understand the limitations of the scoring environment. Mm, Another important question might be, how many periods back in time do we go to obtain data to develop the model? And that's, it depends on how much data you have, how much volatile your business is, how volatile your environment was in recent times. All of the Based on all of that, you might decide to go back a certain period of time. And there is no exact answer, depends on a lot of things, but that evaluation needs to be done. Some of the factors you would use in this decision making as to how much data to go to is, okay, what is the size of your book, how much has your accounts changed over time, how much has your business changed over time. It has drastically changed, then it doesn't make sense to go to something which is too old. uh, but if you don't have a lot of accounts and your nature of business is same, there is some merit in going back uh, many years to pull those accounts again. One has to be careful in looking at older accounts. While that gives you volume for your modeling, if those accounts were from a time, from an economic environment which was very different, then uh, even though your business hasn't changed, that might impact the account. Again, having some sampling of different business cycles uh, um, might make your scorecard more robust. So that is another thing to look at in deciding how many how much, how back you go in. So there is this trade-off. You have these accounts uh, available, and you have to decide whether the extra amount of data you will get makes it worthwhile for you to mm, include them in your modeling sample. Uh, so uh, that is on how much. And then there another question you have to decide upfront uh, is, uh, if you have um, if you if you have different availability of bureau data, archive data, how will you tackle that in your scorecard development? So, for example, you might, for certain number of accounts, commercial bureau data might be available. You might be pulling the individual bureau data, the non-commercial, for only PG loans. So and then there might be accounts for whom none of the bureau data is available. How do you handle all of this in a scorecard development? Uh, and in doing this, it is important for you to understand multiple things. One, how much data um, do you need to build a scorecard? Then, secondly, uh, what are how much segmentation you can have based on the previous question. So if you have a limited number of accounts and you have a lot of different data availability scenarios, where for some you don't have any commercial data, for some you don't have any individual data, all of that, you might not be able to segment all of them differently, because the data to build those separate scorecards don't exist. So in that scenario, you might have to decide, okay, I will just build with the common data available, or that I will uh, build with only a certain amount of accounts, and drop accounts which do not have the bureau data, for example. So these kind of decisions have to be made upfront, and is very important in deciding your credit risk strategy. Uh, the n- uh, if you all have any questions, you all can use the chat board to uh, sh- share the questions. Uh, n- so after we have made those upfront business decisions, the next thing we have to decide is what kind of segmentation we are going to use for our scorecard. And these could be business driven, these could be algorithm driven, and as I was alluding to a short while ago in the previous slide, these could be data availability driven. um, Business driven, one natural way to segment the data, clients do that all the time, is by product and other business structures. This is very intuitive for the business and allow for, even the smallest subset of stakeholders to be involved in the approval process of the different models, because that's their product, they understand it well, it's very intuitive, and so that's the merit. But it might not be the most scientific way. Um, the other approach is a data science approach, where you say, okay, this is my book of business, these are my accounts, and we use data science techniques to say, okay, these are your segments. And when we take this approach, these are optimized for a model performance, but from a business functionality, these might give you segments which do not make sense, and you do not necessarily have the delineation and of different business lines which might be desirable, and you lose some of the uh, clarity you had with business driven segmentation. Another way which is very popular is data availability. Segments are based on availability of bureau, firmographic, and demographic data. And this approach minimizes the need for trying to impute the data and missing values before any scoring, and so you are scoring based on actual real data. And while it is appealing, as I had mentioned in the earlier slide, if you do not have a lot of data, building so many scorecards might be a challenge for you. uh, and then because each scorecard development needs a certain amount of minimum data. And so what each one has its merits. What do you do in practice? It's usually some combination of these. You want to have the clarity of business lines, you want to have robust statistical principles driving, and you want to avoid artificially imputing your data as much as you can. And so you look at everything what you have. Based on that, you try cuts by different types of segmentation, and then you come up with a segmentation approach, which is probably takes a little bit of the business line, but make sure that is statistically data science validated, and then also considers data availability. And for places where data availability is low and you have enough records, maybe mm, pull sub segments there. So something like in those lines. It also depends on budget and everything, because the more models you build, the more scorecards you build, it'll take longer, be costlier, maintenance will be costlier. So all that is considered before the final decision is made. But what I'm trying to do is give you some template on how to make those decisions. So then, after we have done the segmentation, the next thing which we have to consider is the different data types. And in general, for a credit risk scorecard, commercial, in our equipment finance commercial lending space, there would be about 5 types of these uh, data. There could be application data, there could be firmographic data, there could be commercial bureau data, there could be consumer bureau data, and there could be customer or CRM data. And I'll talk a little bit about each of these. And this is and these you're if you are from the industry, you're probably familiar with all of these, but I'll just talk a little bit about it. First of all, the application data. This is data collected directly from the applicant and has information about firm type, size, revenue, etc., the amount of loan needed, all of that. uh, could include This application data could include additional information you might want, like bank statements as well. So that's application data. Then we have firmographic data. This data is collected from commercial data providers and has additional non-credit information about the firm. And this helps us get understand the firm a little bit more, in terms of, okay, what type of industry they operate in. It also kind of provides an external validation, if you will, of some of the application data as well, and is useful to use in the scorecard. Mm, mm. Some of the challenges you get when you're getting external data is that, especially when you're building your scorecard, is, say you say, okay, I'm going to take the last 4 years of applicants and build a scorecard on that. You just can't go to the firm and which is giving you the data and tell them that, okay, give me the latest on these uh, this account list I have created. That would not be correct. When you build a model, you are trying to predict how they will perform based on the information you had at the time of the application. So you need the applicant's date, and then you have to tell the data provider to give you that data as of the date of the um, uh, date of the application, or as close to it as possible. And there might be some challenges. Some of the smaller data providers might not have archives. Some might have annual archives, some might have 6 monthly archives, some might have quarterly archives. And then there is this interesting thing you have to do, where you have to say, okay, for all applicants, mm, like the dates won't match between the application date and the archive date. I mean, it might match for that odd account, but most it won't match, because the archives are by just say quarter. So you will have to decide, okay, which is the date I use for this applicant. Do I use the one just after the application date, or do I use the one just before the application date, or do I use both and take some kind of average? All of these things have to be figured out. And mm, and then so that is uh, and then there is this other thing which you also need to worry about, is that at the end the provider will give you some of these fields, will get into your model, and the provider will give you some data to score your model. This would be most typically in some kind of an API feed, which you will use to do real-time scoring of your model. So you have to make sure that the archive data and the real-time data match up. That is very important. Uh, so that's on for firmographic data. Commercial bureau data. This data is appended from commercial bureau and would include financial, credit performance, contract information about the firm. Uh, um, Sources would be some of the credit bureaus, or and there are some other firms which specialize in this kind of data as well. Um, and again, the archived um, data matching with the application date issue that I just talked about for firmographic data also applies to commercial data. Uh, so that is also very important and needs to be considered. The same issues apply. And it is probably more critical here, because one can argue that some of the descriptive data of firm, even if you take a close enough archive, it doesn't matter. uh, you don't I mean, the industry the firm is working in and things related to it are probably not going to change if there is some gap between the data source and the time of application, but credit information might. And so that is and that is an important thing to consider. Again, you have to be aware of what the API and the matching uh, archive data fields are, and you have to make sure you're using fields which absolutely uh, kind of mm, um, are same. Sometimes you might have to do some mapping because the field names might be different. But you definitely have to make sure the data is available. Okay. The next thing is consumer bureau data. And this is, you might be appending some consumer bureau data for smaller borrowers with PG, or you might be collecting it for certain type of applications, certain products. Uh, and the basic issues are the same. uh, Consumer bureaus have archived data just like commercial bureaus have, and so you have to match application date to archive date and understand the consequences of the decision. uh, you have to match the archive data and the API data, which might mean some mapping and not using fields which are not available in the API data. And you might need to segment by data availability if you are selectively choosing to get PG, maybe the commercial consumer data only for PG cases or smaller loans. So you might not have all this data available for everyone. So you have to design your models and segments accordingly. And then there might be customer data available. This is done less often, let me tell you upfront, but there is an opportunity here. All your applicants are not new applicants. Some have done business with you before and you have data on them. So it might be a good idea to, if this group repeat customer is sizable, to have a separate scorecard for um, uh, customers for whom you have uh, internal data available. Again, because you know their past credit behavior does not mean that you don't use some of the other things, but this is an additional leverage for you. Again, if it is too much, like you don't have the scale to develop such finesse around your scorecards, you might build your scorecard independent of customer data, but use the customer data as an additional additional decision point in making the matrix. What I mean by that is that you create a decision matrix which includes your scorecard, maybe say your custom scorecard, some other commercial scores, and also includes the customer performance on your own loans. And based on that, you make your final decision. Okay. I also want to talk a little bit about reject inferencing. We'll talk more about this in model when we in the next webinar when we talk about the model development process. But there is a data requirement for reject inferencing. The best way to do reject inferencing. Okay, first, what is reject inferencing? Reject inferencing is basically you have rejected a bunch of people and you want to see how they perform uh, or, on other loans. Why do you want to see that? One, you are building your score. When you build your scorecard, you are building it only on people you have approved. But when you will be applying your scorecard, you will be applying it on everyone, including the people you have rejected, because you upfront don't know who you will reject and who you won't. So you need to, if you don't have some reject people, potential there is a potential that your scorecard will not work on them. So you have to make sure your scorecard works on them. So you have to include some of them. Another important reason to have the reject population in there is that there might be an opportunity for you if you are systematically rejecting people because their loans are because of certain criteria you have, but they continue to do well on other loans, then maybe there is an opportunity there to improve your credit policy, relax it a little bit, and get a potentially new set of customers in there. So that is why, if where the bandwidth and budget allows, I recommend reject inferencing. But reject inferencing also has a lot of demands on data. Now you have to get the data not only at the time of application, but for the rejected population now, you need their performance over your observation window from the bureau. So you have to get uh, commercial bureau data. You have to get maybe even consumer bureau data for these individuals over the say 24-month. You observe them to see if they have gone bad, the same term you are using, and then use that in your model. So that is an additional data requirement, and that is why I wanted to bring it up in this webinar. um, so that is uh, something to keep in mind. This will mean pulling this additional data. It will mean also the associate costs and the times needed to do it. But if the budgets allow, it's worth doing it. Okay. So these were some of the requirements for uh, um, developing a credit risk scorecard in terms of what kind of data you need to pull in, and also in terms of or how these relate to everything else you will do. So kind of what your decision process should be. uh, Hopefully, you found this conversation useful, and I hope I will see you in the next two parts of this discussion, which are going to be listed on Eventbrite. The second one is already there, and the third one will be listed on Eventbrite and will be held in November. If there are any questions, I can answer them now. Okay. So one of the questions is that how much of internal technical sophistication do you need to put something like this in place? And so I would say there is a kind of a curve of an organization. And depending on that, you go with what you can implement successfully. One of the key things is I'm firm believer in doing this in incremental steps, and also working within your technology to make it happen. Or if upgrades are needed, that upgrade itself doesn't become like a major issue. You need to be able to score, uh, um, preferably in real time. You make your decisions in real time or in a short interval of time. So you need to put together some kind of a scoring platform that can be done with your existing infrastructure, or can be done with one of the cloud based infrastructures that are readily available and without huge IT requirements on your end. The rest of if you have that scoring platform, the next thing is, okay, you have to figure out, okay, uh, the data, what kind of data you need, and then what are the associated costs. And there, most likely, you are already pulling a lot of this data for your decisions, and so that might be helpful. And we might need some additional data, but we can work with the data you already have. It depends on what you are using, but more often than not, a lot a lot of these fields are used. The rest of the work is then development work, which is done on our infrastructure. So you don't need all the data science tools and all that to do this. That's something, the people developing it, people like us at Jigasa, who will take care of all of that and implement the final solution on your infrastructure. Okay. I have one more question, and that is, okay, what is the advantage of doing this over prepackaged score? And prepackaged score is definitely a very good way to start, and it gives you a lot of mm, it gives you a very powerful tool, honestly, to make your credit risk decisions. But these are, general scores for the product category or industry. They are not tuned to you. uh, and so the next natural step from them is to then build a scorecard. And which in general I've seen across different organizations, that building a scorecard, you might uh, improve, uh, you know or rather reduce your credit loss by 20 to 25 100% by using uh, uh, um, mm, by using a customized score as opposed to uh, you a general uh, prepackaged score. So that is why you want to use it. Of course, there it comes with a lot of additional requirements in terms of maintenance and development in time and resources. So that is the trade-off you need to make. Okay. So thank you all again for joining our webinar, and we hope to see you again at the next one. Have a nice day.